In the X-ticks view, each candlestick represents an equivalent number of transactions. For example, here we're looking at a chart of the E-mini S&P 500. In the bottom chart, each candlestick represents 400 ticks instead of a fixed amount of time. You can see this because the zone from 2:30 until 3 o'clock has many more candlesticks than the zone from 3 o'clock to 4 o'clock. On the classical chart, each time zone takes up the same amount of space. You can see here 4 o'clock to 5 o'clock takes the same space as 5 o'clock to 6 o'clock. This view allows you to identify time zones of high activity. For example, here you can see on this chart there were many more transactions from 2:30 to 3 o'clock. The X-tick view also allows you to show support and resistance lines that you may not have seen in the classical view. See, if I place my cursor here, we see the beginning of this channel on both charts. Here's the beginning, and here's the end. But the channel is only visible on the X-ticks view. We can clearly see the descending channel, and then the breakout, and then the increase of the price. With a classical view, again, we may not have seen this same channel, and also if you do have support and resistance lines in the classical view, then you can use the X-tick view to compare and confirm these resistance breakouts. It can also be very interesting to look at the volumes in an X-tick view. The volume level shown here corresponds to the 400 ticks shown in this candle here. So each one of these volume bars represents 400 ticks. If the volume is greater than the average volume for one of these bars, that means that there are actors putting large sums of money on the market and that a price change could be imminent.